Hello, everybody, and welcome to the live market analysis webinar. This is our first monthly webinar, and hopefully this will be the first of many where we will share our insights, combining the fundamentals with the technicals. And of course, for Elliott Wave specialists, I'm doing this webinar with Juan Maldonado, our Elliott Wave strategist. So if you haven't heard Juan, you're in for a real treat. Some of you are new, many of you are current subscribers and current clients. So we welcome everybody. Okay, we welcome you, and we hope that you take something back very important that you can use in your trading for the next few weeks. So what are we gonna, we're gonna start with the disclaimer, so just read this to yourselves. And we're going to talk about our current analysis of certain stock indices, currencies, and commodities, and show you how the new Elliott Wave scanner pinpoints trends, the best markets to trade right now, and we're also going to focus on the fundamentals and some tips using Fibonacci and Elliott Wave tools on Motive Wave software. Okay. Today, we're going to start with the fundamental overview, and the fundamental overview will include key market drivers. Okay, what's driving the market today? What do we need to look at to see what's driving the market? Because if we get a comprehensive view of what's going on out there, don't you think that will give us more confidence in the trades that we're taking? I should hope so. We're also going to look at the scanner trends and how they've changed over the last few weeks. And then Juan is going to do wave counts on oil, the S&P, the euro, and gold. At the very end, I'm just going to show you an opportunity to join our Elliott Wave desk and get the scanner. So let's start with the big picture view. And when we talk about the big picture view, I'd like to focus on oil, because that's been in the news of late, the FOMC minutes from yesterday, and risk appetite. Intermarket analysis is really important in understanding market correlations and what's driving the markets. So what intermarket analysis means is looking at oil and see if it impacts the currencies or the stock market, for example, and how does it impact those other markets? Because if we understand how the markets are related, then we can look at the different markets and get a clue for the market that we are trading. So for example, if we're currency traders, we can have a look at oil in the stock market, learn the correlations, and see how it affects the currency markets, and vice versa. If you're a stock trader, you might get some clues by looking at the dollar-yen, for example, and I'll explain that. So at any point in time, there are different drivers. And currently, the drivers are oil, and most recently, yesterday's FOMC minutes to show U.S. economic activity, along with any other economic releases that come out during the course of the week. And the key question is, what is the effect that these drivers have on risk appetite, risk on and risk off? And let me explain risk on and risk off. And this, I'm just getting this definition from Investopedia, so I'm just going to read it to you. It's risk on and risk off is an investment setting in which price behavior responds to and is driven by changes in investor risk tolerance. So risk on, risk off refers to changes in investment activity in response to global economic patterns. And during periods when risk is perceived as low, the risk on, risk off theory states that investors tend to engage in higher risk investments. And when risk is perceived as high, investors have the tendency to gravitate towards lower risk investments. So we have those proxies for risk in the markets that I'm going to discuss. And you need to understand those proxies. Otherwise, how do you know if the market is taking on risk or shedding risk? And I'm going to show you how the market has been moving consistently all the markets have been supporting one another with the risk on, risk off view. So, for example, last week, risk appetite was absolutely crushed with dropping oil prices. And in combination with dropping oil prices, because they're all related, stock indices dropped, the dollar dropped, and gold moved higher. So let's take a look at that right now. And this is charts showing risk off. So have a look. This is oil. This is the daily chart of oil on the left. I'm just going to right over here. Hang on a second. Let's change the color. Okay. So this is oil. And you can see a steady move lower. This is the S&P, same period of time. This is the dollar yen, same period of time. This is the euro. Now the euro was moving higher because it's inverse to the dollar yen. The dollar is still moving lower. When the euro moves higher, the dollar moves lower. This is the DAX, just to show that it wasn't just the US market. So DAX moved lower and really all of the stock markets did. And then gold moving higher. So we had correlation among all the markets. And this is very interesting when this happens, because then you get a good idea of the key fundamental drivers and the risk on, risk off. So this was risk off last week. Now, everything turned about face, as you can see. So we will discuss what happened, what caused it to turn, and what the drivers were for this week. But I can give you a clue. On Friday, the sell-off of these markets, or the risk off, was stopped dead in its tracks when U.S. retail sales came out and they were better than expected. So that meant economic improvement, and that led the market to think, okay, if that's the case, then maybe the Fed, the minutes will show that the Fed is more hawkish and will raise rates sooner rather than later. But let's move on. This is a snapshot of our proprietary Elliott wave scanner showing the risk off. And this, all I did was I took the same markets that we looked at, oil, S&P, dollar yen, euro, the DAX, and gold, and I took the scanner values to show how unanimously bearish Brent crude is. The S&P, red means bearish. The dollar yen, all red. With the exception of the weekly time frame, we can still be in an uptrend on the weekly, but be in downtrends on all the other time frames. And this is from the weekly down to the 5-minute. The euro, as it's the inverse of the dollar yen, green for the most part. The DAX, red for the most part, and gold, all green. So this was last week. It's quite stunning, isn't it? Now let's move on. So this is a risk-off appetite, just a risk-off appetite for risk. The market is shedding risk, and that's why we had sell-offs in the stock markets, etc. So now let's talk about oil as part of our big picture view. Oil, the FOMC minutes, and we already talked a little bit about risk appetite. So now we have an increase in risk appetite kicking off on Friday. And what's been going on with oil? Well, on Tuesday, Iran decided to cautiously support a proposal by Saudi Arabia and Russia to freeze production at near record levels. So prices rose, oil prices rose. That is the immediate reaction until the economists and strategists can analyze, well, so what if prices rise? What is the supply situation like? The price is driven by demand and supply. So if if they're going to stop production, freeze production, is that enough to decrease the supply to cause prices to rise? Well, the next point is, but with so many more producers, Saudi Arabia and Russia can't single-handedly affect oil supply and demand. And by the way, Saudi Arabia and Russia are the top 2 producers of oil in the world. So they wanted to get other oil suppliers on board, okay? But it is significant that they are doing something about it. It's sort of, I think word of this may have, well, it sort of caused oil to stop dead in its tracks and move higher a bit, but it is causing the market to ponder. So what does this mean? Does it mean that oil will not hit $20? Will oil stay between 25 and 35 for the next several months? What's going to happen with oil? And certainly you'll have a look at our market view for oil when Juan does his Elliott wave analysis of oil, and you will get a sense of what we're thinking from an Elliott wave standpoint about the price of oil. Okay, and then today, of course, after the 11 a.m. release, oil gains eased after data showed U.S. crude inventories advanced to an 86-year high. So oil sold off a little bit. So it's all of these news factors, news items, event risk that we need to take into account before we're initiating any positions and as we're trading. But I like to look at the news as the big picture view, the context for what's going on, and then I'm very happy to look at the Elliott wave count and whatever else analysis we do in order to make trading decisions. So that's oil. And let's see what happened after Friday. Well, Friday retail sales reversed risk off. So this is now risk on. Oil moving higher. S&P moving higher. Dollar yen moving higher, although it has sold off. Dollar yen is another story. Euro moving lower. Again, the inverse of the dollar yen. Euro down, dollar up. DAX moving higher. And gold selling off a bit. So this is the risk on environment, okay, that we're in as of today, as of right now. So now let's look at the scanner. So the scanner, it gave signals. The lower time frames will always flip first. They'll always turn over first. You can see that the scanner is very well mixed right now, with the exception of yen and gold, which seem to be entrenched in their downtrend for dollar yen and uptrend for gold. Okay, but in terms of the other markets, the scanner, when it reverses, like in the example of like oil or the S&P, when they flipped long, they would flip long on the smaller time frames first. The longer time frames are always going to stay short if the downtrend is short, unless the bigger trend actually turns. Okay, so that's today's scanner. So now let's talk about the FOMC minutes from yesterday. Well, there was a whole lot of activity going on leading up to the FOMC minutes, so that it was like almost a non-event. It had a very muted effect on the markets. The minutes suggested that policymakers would adopt a slow path of interest rate increases this year. Okay, so more dovish. And they debated the potential impacts of oil, China, the dollar, and the financial market volatility in the context of a strong U.S. labor market. So mixed things going on here. The U.S. labor market is strengthening, but since December, there's been a whole lot going on to cause uncertainty with oil, China, and the dollar, and financial market volatility. So they said that it increased the downside risks to the U.S. economy and the uncertain inflation outlook. And there's a possible drag on the U.S. economy from the slowdown in China, right? How will that impact the U.S.? China affects everybody. And the tighter financial conditions that they alluded to is almost equivalent to tighter monetary policy. In other words, that it's having the effect of raising rates. So that means that they probably won't raise rates in the short term, not this month, maybe not next month. We'll have to see. So the FOMC minutes, yes, the market definitely looked to see what would happen with that, and it was just a non-event. So now let's just talk a little bit more about risk appetite, risk on and risk off. So we shared that we want proxies for risk appetite and risk on and risk off. And we noted that the stock markets and also dollar yen, when dollar yen is moving down and the stock market is moving down, that's risk off. When the dollar is moving higher and the stock market is moving higher, that's risk on. And of course, oil and gold, because those are the commodity prices, so they have a natural impact on risk appetite as well. And when commodity prices are moving up, risk appetite is increasing in this case. So let's look at the dollar yen and the S&P to show you how they are very highly correlated and therefore a proxy for risk appetite. This is taken from Motive Wave. I use the instrument overlay function. Many of you are using Motive Wave. And this is taking the instrument overlay function on the dollar yen. So the S&P is superimposed on the dollar yen, and you can see the strong correlation between a move up in the dollar yen and a move up in the S&P, and then the dollar yen flattens out, as does the S&P, and then the dollar yen starts to move lower, and it looks like they both moved lower at the same time and did a nice three-wave corrective sequence down, which you will learn about when Juan does his Elliott wave analysis. Three waves are corrective. The start of the move that may or may not lead into a five-wave full trend reversal. So this shows that dollar yen and S&P are highly correlated. So that means if you are trading the dollar and the dollar yen in particular, you want to look at the S&P. If you're trading the S&P, you want to look at the dollar yen for clues about your market. The dollar yen right now, in light of what we just talked about, is a little bit mixed, with Fed tightening on hold, pushing it lower. Okay, right? Lower dollar, Fed tightening on hold, and the risk on pushing it higher. So you can just see a long tail down here and how dollar yen sort of spiked higher. This is the weekly chart, so we really can't see the price action on the weekly chart. You can tell, though, that the sellers were in control, and suddenly, towards the end of the week, the buyers came in and took it higher. So my message to you for the upcoming weeks is to continue to watch U.S. news releases to see economic improvements, albeit slow. Continue to watch oil, continue to watch news out of China, and continue to view if the market is in risk on mode or risk off mode. So now I'm going to turn it over to Juan, and Juan is going to do the wave counts on oil, the S&P, the euro, and gold.
And thank you very much for being here. My name is Juan Maldonado. I'm going to explain our view from the Elliott wave theory technique in these markets. Let's start with oil, where the price is in a clear bearish trend. As you can see, the price is making new lows. So here we have the previous significant pivot on the left. We're calling this level, that's the 38.17, we're calling that a wave 3. And in terms of momentum, was the strongest in the oscillator as well. That helped us to confirm that that's a wave 3. That is why in our service we suggest to follow the price after the wave 4, and has been working nicely. Now the price is divergent with the oscillator, and divergent means that it is losing momentum, but that doesn't mean that it's going to reverse. So it's just a warning that the price is losing momentum, and soon will end the bearish move, but it's not a reversal signal, and I will explain why, because the wave can't inside. Okay, so that means that we are in a cycle that is called the wave 5. The wave 5 always is going to have 5 waves inside. Currently, what we have right now is the 3-wave sequence. Inside, for that wave 5, we have 1, we have 2, and here comes the wave 3. In order to calculate the target for the wave 3, we need to use that tool in MotiveWave that we can click on this degree of the waves, and then with our keyboard we can go Alt 3. Another way to get this FIBO is by making a right click on the degree and then go to ratio analysis, and you choose 3 versus 1. So as you can see, the shortcut is Alt 3. Okay, so that target is the 24.31, our target for the wave 3. The wave 3 needs to reach at least the 100% of the wave 1. Another important detail that we can see in this structure down is that each wave inside has been taking the shape of a 3-wave sequence. So if you are a little bit familiar with Elliott wave, you can find this weird, having a 3-wave sequence for 1, having a 3-wave sequence for 3, but this is because it's making an ending diagonal wave. The ending diagonal wave, then the wave 4, is a deep retracement that should come inside the wave 1. Right now we are inside the wave 3 on the daily chart. And that's the price, and that's the structure that we need to focus on the next time frame. As you know, the markets are fractal, and we have waves inside the waves and more waves inside the waves. So the last leg for our wave 3, and that target that we were seeing on the daily chart, is an easy structure. Is another diagonal wave. I think that the oil is making all these diagonals because all the fundamentals and all those things that are happening in the world. This is 1, this is 2, this is 3, this is 4, and then we expect the next leg down the wave 5 to the 100%. Precisely today, in one of the classes with our students, we were talking about where was likely to have the completion of the wave 4 in order to start looking for trades. Because don't forget that the Elliott wave theory itself is not a signal technique. Elliott wave itself is not going to give you the trigger. This is analysis. What is going to give you a trigger is the breakout of a level, a strategy, like the wavy tunnel that we teach, that is going to teach you and show you precisely where to trigger the trade to validate the wave that you are looking for. Another technique that we use in our system is the harmonics. So this is going to become a little bit more advanced, and actually I'm going to hide some of the waves because I don't want to confuse you. But if it's the first time that you see harmonics, don't worry, it's actually something very simple, and if you want to learn about all the harmonic patterns, we have a fantastic course for that. But in this case, the pattern that we found was a Garley. So we were live this morning in our class. And the target for the Garley is the 78.6. So actually, Fibonacci retracement, the 78.6%. The idea with the Garley is that this is going to give us a strong resistance area where the price is likely to reverse. And as you can see, precisely there, it reacted and started to show the move down. Yeah, because some fundamentals, because some news that happened, but the technical analysis was able to forecast the next move. Now let's go to the hourly chart, and I'm going to get rid of the harmonic because I don't like to have so many things in my screen. And let's focus again on the wave theory. On this time frame, clearly we have a three-wave sequence. This is completely objective. Three waves. Something that I really like about this three-wave structure is that it's divergent inside. In our system, we call this a gift from the market when we have divergence inside of the corrective and the convergence with the Garley. So our wavy tunnel technique gave us a trigger on the 15-minute chart, on the hourly chart. We have triggers for everybody. But also if we are using classical trend line, for example, that could work too. But always validate. Never try to use a wave count to trigger the trade without validation. All the techniques in the technical analysis need to confirm. You need to confirm all the techniques, always. So be careful with that. The Fibonacci retracement is not enough. An engulfing candle is not enough. That can fail. Divergence can fail. But then confirm, always confirm your analysis. Okay, so we have a clear scenario for the oil. And of course, the scanner also showed the confirmation, our proprietary scanner showed the confirmation of the end of the wave 4. So we have so many ways to confirm the end of the trends. A plan right now in terms of the Elliott wave theory is that we are seeing here 1, 2, 3, 4, 5. That will be like the 15-minute chart, but I'm just labeling from here. The markets are fractal, and this would be the wave 1. Then we expect the wave 2. The wave 2 is a three-wave sequence that usually is like the pullback to the trend line, is also the head and shoulders pattern. So we can say that this is the shoulder, this is the head, and this will be the second shoulder. So shoulder, head, and shoulder. And there is a neckline. So that's the reversal. Of course, we need to continue giving actually confirming the end of the wave 4. So that's the next step, and that will be the trade. So let me clear this up for you. wave one, then we expect a three-wave sequence up without making a new high. If the price makes a new high, of course, this doesn't have any sense to keep the trade or to take in a decision. So the trigger, a simple trigger for the oil, will be a trend line waiting for the three-wave sequence, and then the breakout. That will be the trigger to be part of this move down. Always manage your risk. Always wait for confirmations, and that will be the plan. And of course, you can add in motive wave, you can add here the waves as well to calculate the Fibos. So this will be 1, this will be 2. The wave 2 usually is retrace 50 or 61.8% or sometimes 78.6 of the wave 1, and the wave 3, wave 4, and wave 5. So there we go. That will be the plan for oil. Do we have comments or questions about this?
Yeah, Juan. So this is excellent because this confirms the fundamental view on oil that just because there might be a price freeze and that other oil producers will come on board doesn't mean that the supply is going to get less, because there seems to be still a lot of supply in the markets, which bodes well for this wave count, where we may have seen a top for the price of oil, and we just very might well trade down to the 25 level, and then after that trade within that broad range. So thank you. Excellent analysis.
Thank you, Jody. Okay, we have a question. Will you measure the head down to the neckline, then from the neckline down to 1,000? Let's see. What do you mean with 1,000 here on oil? The head and shoulders, here will be the shoulder 1, the head, and here the shoulder 2. The target for the whole move, if that's what you mean, it will be the 100%, 24.31 area. Okay. Let me know if that answers the question. If not, we can go back to it.
In classical technical analysis, I think what Carol is saying, you measure the distance from the head to the neckline, which you were doing, and then project it once price breaks down through the neckline. The projection would be the length of the top of the head to the neckline. But we're more sophisticated than that with our Elliott wave analysis. Okay, let's move on.
Okay, great. Let's continue now with the S&P. The S&P has been tricky, has been very complex during the last months, during the last weeks. But actually, we have been extremely successful forecasting all these complex moves. What we found with Elliott wave is that actually the S&P is doing something simple, and it's a three-wave sequence. 3 waves. When the price dropped the first time last year, we were seeing that the indicator was showing a lot of momentum. And then, thanks to that information, then we knew that the move up was corrective, was fake. Corrective, was a trap. And that was necessary to see the price coming down again, eventually, to make a new low and show divergence. Now we have that. So the advice inside for our clients has been to take the shorts during this move down. The price already react at that support. If we focus right now on the candlesticks, we can see that that's a strong support. Let's see, for example, this candle here, long weak candle rejecting the support. Then a second attempt and fails and creates an engulfing candle. We think that the bearish move is over, but as always, we need to validate. How can we validate the divergence and the end of the wave 4 and everything? Because if we are right, the next destination for the S&P will be the previous highs, 2130 area at least. So let's get ready for that fantastic trade. The daily chart is showing a strong and a steep move that went today to the 1939, 1938 area. On the 4-hour chart, we're seeing that the price completed the first Elliott wave structure, wave 1. In order to validate the wave 1, we can have a simple trend line right here. And once the price shows the breakout, and a valid breakout is when you have a nice candle, let me go with red, nice candle breaking down the trend line, and then a pullback to the trend line that fails to get in again. That's the ideal breakout in order to start taking some shorts for the wave 2. The wave 2 targets, and if you are using MultiWave, you can do Alt 2 in your keyboard to get all the Fibos for the wave 2. The wave 2 at least goes to the 50%. I like that target because it's the previous wave 4 area. And that will end then the wave 2. What we're expecting to see in terms of Elliott wave is a 3-wave sequence. So A, B, and C down, 3 waves. We can do the same exercise, but here on the big picture, the one that we just did with oil to validate the end of the wave 2. Let's add here the trend line, having 3 waves, maybe a divergence here inside, and then a candle close above the trend line. Wow, that's a fantastic trade. That is a fantastic trade for the S&P. Of course, we can trade during the wave 2, but that's another thing that Elliott wave will provide to your trading plan, and is that when you're trading inside corrective waves, you need to lower the risk because it's going to be more complex to trade inside of a corrective wave than trading during the impulse. It's easier on the impulse. And the hourly chart is now showing also divergence. Let me increase here my indicator. So there I have the divergence, and now I'm looking for validations. If I look here on the hourly chart and I have here this trend line, the price is trying to reverse. It's trying to reverse with that trend line. So the breakout, look for pullback, take your trade, manage the risk, manage the trade, and just follow the move. That's going to be the plan for the S&P. It's clear. Do we have questions or comments? Oh, here we have a question. Where will you place your stop if you will go long after the second wave? Okay, that's an excellent question. So the question is that if everything happens as expected, if we go this ABC down, we have here our trend line, and then we have the trigger. So here a candle close above the trend line. The question is where to place the stop. With our technique, with the wavy tunnel, we use the wavy tunnel to place the stop loss. But if you don't have that technique yet, I will suggest to leave it below the possible end of the wave 2. Because ideally will be to leave it below the previous end of the wave 4. That will be safer. But we don't know yet how deep the wave 2 is going to be. In case that the wave 2 goes to the 78.6, 88.6, you can use the previous low as the stop. But if we go just 50 or 61.8, we will need to use the end of the wave 2 to set the stop loss in that case.
Okay, there are 3 questions asking about, and you just answered it, asking about the wave 2 pullback. And Juan just answered the question. But besides that, you can see the Fibonacci retracement tool to the right on the chart, which shows the potential for the wave 2. So wave 2 can retrace up to 100% of the wave 1 as long as it doesn't break below the start of wave 1. That's one of the rules of Elliott wave analysis. Okay, great. Let's move on to the next instrument.
Okay, now we're going to check the euro. Let's go now to the currencies. The euro is reacting fantastic. We were able to find the end of the wave 4 very successfully in our service. We did something similar as the example I show with the oil by using a Garley. Again, if you don't know about harmonics, don't worry. It's just a technique in order to find a precise level where we are expecting to see a reversal for a corrective wave in this case. The Garley was saying that the reversal area for the euro was the 112.86. As you can see, the price went a little bit higher than the Garley level. That is why we need to find the way to confirm the waves and to confirm the end. Just because the Garley or just because a feeble retracement or any other technique to find support and resistance might not be enough to take a trade. It's safer to find the validations. But that was our area. We were looking to find after that level the short trades, and I will show you in a second how we validate that and how we get in the market. The other detail that I want to highlight is this doji candle. The doji candle that happened during the bullish trend was also showing that the price was losing momentum and that the move up was likely to complete or end soon. That was the meaning of that doji. So that's also important to understand how to read the waves and how to understand these signals. Okay, so we have in that moment everything in place, the Fibonacci retracement, the Garley, the Elliott wave analysis. Now let's continue and let's go to the next time frame on the 4-hour chart. What I did to find the end of the wave 4 was quite simple, and is this trend line and this channel, and of course with our technique with the wavy tunnel also help us to find this. Okay, so you can see here the price hits the Garley, the level, and this price action right here, these candles are the ones that are represented by a doji on the daily chart. And the price couldn't confirm, didn't close below the trend line, so we're safe. Yeah, the Gartley was hit, but the validation didn't happen. Then the price moved slightly higher, and we have the candles closing below the trend line. That was the validation. That was the trigger. That was the confirmation. The price went down to the last low was the 110.68. We already advised to our clients to take profits and close the trade, or at least tight the stop to this trend line here in sight, because the euro is ending the wave 1 for the new cycle. So it's better to take profits, wait for the retracement, and trigger again. Some traders like to go against the impulse, against the trend, especially if you're day trading. Actually, you have to do it with a lower risk. Now let's talk about the future. What we are expecting, the projection. As I already said, we're expecting to see soon the end of our wave 1. Inside is just ending the 5-wave sequence, very choppy, overlapping market today during London and New York. So we're expecting this first. We can have here a trend line as well. Something like this will be the confirmation for the end of the wave 1. And here comes Elliott wave again to help us in order to understand the wave 2. The wave 2 always is going to have 3 waves, at least. There are corrective, double corrective, like double 6x, but at least 3 waves. So be careful, because some traders try to short after the first leg. And that is why this is called, this section right here is called the trap, the bearish trap, because the price moves down thanks to all the traders who short after that leg. But then the price makes a new leg up, because the wave 2 has 3 legs. So from now on, when you're expecting any corrective wave, especially a wave 2, you are going to wait for the 3-wave sequence. Let's plan the trade again. So what I'm saying is that we will expect an ABC up to the 50, to the 61. We don't know that yet. We have to wait. Then again, do the same at your trend line. Only if you have 3 waves, take the trade. If you have divergence inside, even better. Or another technique that you can confirm the end of the wave 2. And that's going to be your trade, your trigger for the euro to be part of this trend. So by using Elliott wave, we can understand where is better to take the profits, to get out of the market, to wait, and to plan the next trade.
Okay, excellent. There aren't any questions here for the euro. So why don't we move on to gold?
This is gold. This is the daily chart. At the beginning of this move, when gold was starting to move higher, it was kind of confusing. So our advice during that moment was to wait for any validation for any continuation short, like for any breakout here in order to try to make a new low. But once we start seeing the price accelerating to the upside, we understand that gold was changing of trend. And I believe that this is major. Let's go to the weekly chart so you can see this better, the big picture. And I'm going to hide here some of the waves to make this very simple for you. So this is a retracement on the weekly chart. What I'm saying is that the seems that is over, that the corrective wave is over, and the price is turning around to go up again. That is why we're seeing these strong candles on the weekly chart. Plus, finally, after months, after actually years, the price has been trending short below the main weekly trend line. And last week, we had the breakout of that trend line. And this week, the pullback. So this is a major reversal. And of course, the divergence is there to validate what we are thinking. Also, this was a wedge formation. And you know that a wedge is powerful. The wedge will show bullish price action. Okay, so now that we have a clearer scenario with gold, what we did today in our service, I tape a daily video explaining all these setups. So we were here this morning, and actually I want to, let's explain here the wave count first on the 4-hour chart, and then I go to the hourly chart to show the trade that I suggested this morning. Okay, so there is the wave 1, the wave 2, the wave 3, the wave 4. Okay, that looks nice, but how can we validate? How we can know, how we can find the end of the corrective wave? Because actually that's the trade. And that's one of the issues, that's an issue with the Elliott wave theory. And is if you have an impulse, can be any wave, 1, 3, A, any impulse. And then you start seeing the retracement. For example, let's say this is a wave 1 and you're finding the wave 2. So the question is when that wave 2 is going to end. Is going to end at the 50%, 61.8, 78.6, 88.6, or is going to invalidate? We don't know during the corrective wave. So by using our tools and by using our scanner and using all the tools that we provide, that's what we do to validate the end of the waves. Because just with Elliott wave, it's impossible to know where the wave is going to end, because Elliott wave has so many retracements. So let's focus here on the wave 4. What I suggested this morning was quite simple. I said the price is in this consolidation. I believe that we are going up and that the wave 4 was done, but because the things I believe is not enough, we need triggers. So the advice was quite simple. If the price closes above this triangle line, looks like a triangle, but it's not an Elliott wave triangle, take the bullish side of the trade. So that means buy, right? If we have a candle close below the lower line, take a short, because that will mean that we are going to have a deeper wave 4, and the wave 4 will be something like this in that case. So here was the scenario today in the video for both, for bullish and bearish. And as you can see, the one that validate here was the bullish one. With this nice green candle closing above the trend line, was telling, okay, I'm going up, get ready. So that was the trigger. Destination, at least we are conservative always, the 1263. 1263. Now you're late for this trade, so what I suggest is that if you're a swing trader, you should wait for the end of this wave 3 and then trigger again after the wave 4. That would be my advice. If you're day trading, you can try during London to be part of this wave 3. That is just in the middle. So that's going to be the plan for gold.
Thank you very much, Juan. That was excellent. Certainly, everybody in this room has gotten some really good ideas for the next few weeks going forward in terms of what we're thinking with the trends. And Juan went so far as to explain how to trigger trades. So excellent. Now I'm going to take it back and just show you what we have to offer. I know we have a lot of clients in here already, but if you want to continue with Juan's wonderful wave counts, then this is how you can do that. By signing up for the Elliott Wave Desk. And this is the website that you need to go to sign up for the Elliott Wave Desk. And I guess we'll post this in the chat box. fxtradersedge.com/EWD. I'll try to post it here. Maybe Juan, you can post the link in the chat box. And this is where you go. So let me just show you what is on that page. Here, let me post it for you. Hang on a second. Okay, it's posted. So let's see what you get on that page. First of all, here is the scanner. I only showed you clips from the scanner, but the scanner shows 36 currency pairs from the weekly on down to the 5-minute, and this updates every minute. Okay? And when you go into the CFD heat map, we have 31 different commodities, indices, and interest rates. Okay? 31 different CFDs. And then we have US stocks as well. We have 81 different US stocks as part of the scanner. And this is updated on a minute-to-minute basis. Okay? Every minute it's updated from the 1 week down to the 5-minute. And what you see here is you see the current price. So this is the current price. And you see the time and date stamp for when the trend changed. And this is the weekly. So the weekly changed at 87.78 for 3M. The price is now 156.65, and it's been long for 209 weeks. That's how you read the scanner. So that applies to every single time frame from the weekly down to the 5-minute. So I thought I would just show you more of what it does. Now let's get to the Elliott Wave Desk itself. This is the Elliott Wave Desk pricing. You can join us and you'll get daily 4-hour and 1-hour charts, and you'll get daily analysis and video by Juan on the euro, the pound, the Aussie, the dollar yen, the New Zealand dollar, the dollar Canada, the S&P, gold, oil, the Dow, the NASDAQ, the Russell, and the DAX every single day. So that's the page that you can go to order. And if we scroll underneath to gain access to the scanner, 1-year access is for $299. Okay, and that's about it. Let's just post the link again. And let's just post the link again for this promotion today. And I want to thank everybody for being here. If we didn't answer some of your questions, you can send your question to support@fxtradersedge.com, and we'd be happy to answer your questions. And if you want to see this presentation again, we will post it on the FX Traders Edge website. So thank you very much, everybody, for attending, and we hope to see you in the rooms. Thank you, Juan.